Good afternoon, everyone. It is June 20th of 2023. We're certainly glad that everyone could join us this week. I hope that everyone had a fantastic long weekend, and we certainly have a lot of things to review today, because right now, what we are navigating through is one of the more historic asset bubbles that we've gone through in our career, in our opinion, and we think of all time. And right now, in technology in particular, we believe, based on our work, that investors are in a danger zone. And what makes this particular bubble dangerous is that it's involving the stocks that are the most widely held across the planet. So we want to go through what all of this means for those investors, our investors, your portfolios, what we're doing about it. And really, if you think about it, we're focused on areas outside of technology right now, and that's been kind of dead money for the last few weeks, and we're okay with that. Because the way that stock markets work is that nothing happens and then everything all happens at once. And we learned that lesson in 2021, 2022, that sometimes trades take time and then they all go at the same time. And so we want to be positioned the right way. And we're going to go through what all of that looks like this week. So let's go ahead and get started. As we said, the mother of all bubbles. The three big things that we want to go through this week is, we're really concerned that this fear of missing out on the artificial intelligence bubble is going into overdrive. And we've seen that over the last couple of weeks. And it's not just AI specific names, but it's those FANG names like Facebook, Apple, Netflix, Google, NVIDIA, etc. Technology, to be very, very clear, in our opinion, is in that danger zone. And just to kind of get a sense of how frothy AI is, the number of times AI has been mentioned in the news is now approaching 2000 levels as it relates to the internet. And we know the internet was in a bubble. So we need people to separate the fact that, yes, AI is real. It is a thing. It's going to revolutionize our economy. We believe all of that is real. But so was the internet. And if you bought into these internet stocks and these concept stocks and these story stocks in 2000, you did lose a lot of money. And so we want to make sure that we're not making those mistakes, especially as we look back at cloud computing stocks and crypto back in 2021, 2022. Lessons need to be learned, and you don't want to make the same mistake twice. Number two, we do believe that the reason why this is one of the more dangerous bubbles is that these stocks form the center of most investors' portfolios, right? So those top 7 stocks in many cases are over 30% of the S&P 500, and people own those indexes. And so that represents a danger to the index and represents a danger to a lot of people's portfolios, because not only do they own the index, but they own these individual stocks in complement to the index. Number 3, outside of that danger zone, we want to be nuanced about this. That doesn't mean the entire market's bad. That means those particular areas of the market are dangerous. Outside of that, there's a lot of great value stocks out there that are growing, that are well managed, that are at a very attractive valuations, especially relative to technology. And we see that panic that is setting in. This is the volume of S&P 500 call options, the highest it's ever been, and this was last Friday. So a picture says 1,000 words. I don't want to spend a ton of time on this, but when you see these types of charts, it shows the deep panic that people are in to participate in this fear of missing out technology bubble. We're not there, and we're okay with that. If we miss 2 or 3 weeks of the very end of the trade, guess what? If we're right and it pops, it's going to only take a couple of days to reverse what has been a 2-month rally. So we are okay with that, and we prefer to focus on the average stock and stocks that we think are going to be entering a new secular bull market cycle. The other reason we want to be careful, of course, is when we look at what the bond market is telling us versus what the stock market is telling us, right? The S&P 500 is in clear breakout mode, but it was in clear breakout mode in late 2000, early 2001 as well. Right? We saw the NASDAQ pull back 37% as the dot-com bubble burst. We then saw it rally 35%. And then it went down another 50%. So we want to be careful about what we're assuming just because the stock action looks very attractive in this area of the market that is extremely frothy. When we look at the bond market, on the other hand, we see the 210 curve continues to invert close to minus 100 basis points. So there's something there in the bond market that, despite the rally in the stock market, is giving bond investors serious pause about what's taking place in risk markets and serious pause about what's taking place in technology. And lastly, the economy. And we'll review all of that today. As it relates to the economy, if we think of what the Federal Reserve did on last Wednesday, they were very hawkish, right? Market was assuming a hawkish pause. In other words, a pause, but complemented by indications they would raise interest rates one more time. Well, it was a hawkish pause, but they indicated interest rates would increase 2 times. But guess what happened? Something interesting happened in the bond market. Interest rates went down. And part of the reason why we think that's happening is some of the data, the leading data, is actually finally starting to show evidence that those interest rate increases over the last year are beginning to slow things down. Jobless claims in the US, over 260,000 jobs again for the second week in a row. We look at US continuing claims. They're starting to trend higher, as are permanent job losses. So those people that are unemployed for a structurally longer period of time. This is the first time this has been happening since the onset of COVID. Prior to that, that's the first time that's happened since the pre-08 financial crisis. So I think these are things to pay attention to. Again, does that paint the entire market in a broad brush? No. I think this is closer to the 2000-2003 cycle, and we want to focus on those nosebleed valuation corners of the market, such as technology. So what does a bubble look like? I want to be very clear. Apple's a fantastic company. It's a great company, one of the greatest success stories in American economic history. But the stock is expensive. Right now, Apple is greater than the value of the entire consumer staples sector of the S&P 500. Well, Robert, what does consumer staples even mean? Well, they're companies like Colgate, Kraft, Philip Morris, Costco, Walmart, Pepsi, Procter & Gamble, Coca-Cola, General Mills, Altria. That's just the top 10 of a 100-company sector. All of those companies combined are not worth as much as Apple. Now, individually, you could argue Apple's a better company than all of these, but should it be worth more than all of these companies combined? This is what happens during a bubble. Again, this is not a guilty verdict against Apple as a company. It's a great company. It's just really, really expensive. It's like me saying, listen, I will sell you a Model Y Tesla, which a lot of people love, and it's a great car, but I'm going to sell it to you for $1 million. And you say no. And understandably, there's a reason why you would say no. That's way too expensive for a Model Y car. Apple's no different. This is a great company, but at today's prices, we just think that these stocks are just incredibly expensive. This is the combined weight of the 5 largest companies of the S&P 500. So not the 7 largest, doesn't include a couple other companies out there. But Apple, Microsoft, Amazon, NVIDIA, and Google now make up a quarter of the market, a quarter of the S&P 500. So when you buy an index, a quarter of your money is going into just 5 companies. The peak in 2000 between Microsoft, Cisco, GE, Intel, and Exxon was 18.2%. A bubble looks like a bubble, right? You see a bubble, you know a bubble when you see it. This looks pretty bubbly, right? And then we look at Apple versus the consumer staples sector, what we showed in the previous slide, but this time on a line chart. Again, Apple is greater than the value of the entire consumer staples sector. And we see that blue line crossing here over the red. That's not normal. That shouldn't be happening. All of these companies combined are really not worth more. If you think reasonability, use a reasonable person test, probably not worth more than all of those companies combined. In fact, it's worth more than Canada. It'd be one of the G7 countries in the world. Does that really make sense? Again, a great company, just very, very expensive. So what's the trigger? What's going to cause this bubble to pop? And what's going to cause assets and cash to flow out of this deeply concentrated pocket of the market in technology and into areas like energy or materials or consumer staples? We believe the key is for growth to value, the growth to value rotation to turn back on, right? So in other words, as interest rates, as the real yield continues to fall on the or as the real yield on the 10-year continues to rise, that at some point triggers an outflow out of growth and back into value, right? So this is the 10-year yield inverted. So as it's going down, that means the 10-year yield's going up, overlaid against the growth versus value trade. You'll notice a big distortion that's taking place here. In the past, and you go throughout history on this, is that when the 10-year yield is rising or the real yield is rising, value stocks outperform growth. But that has completely dislocated itself over the last 2 to 3 months. And we think that there's going to be a mean the reversion trade here where value is going to quickly catch up to what growth has been doing this year. And those people that are stuffed into the growth trade are going to face that second round of deep, deep selling, just because it is so out of consensus right now and not expected. We go back to what is the most important chart of the 2020s, the commodities to equity ratio. This is where the deep value is, in our opinion. This is where we think the next bull market is. This is how we are positioned. As the US dollar peaks out, as oil demand recovers, as oil supply peaks out, we like energy. We like gold as a hedge against the US dollar. These are the two key areas that people are not positioned in that are of deep value. Energy is the cheapest sector on the S&P 500 and are experiencing high quality earnings growth. And energy is well positioned. So this is one of my favorite charts right now. When I look at the earnings weight relative to the sector weight of the S&P 500. So when we think of technology, the sector weight is about 26.1% of the S&P 500. Add in communications, and you're actually closer to about 34% or so of the S&P 500. But its earnings weight is only 19.2%. So its earnings weight of the S&P 500 is 6.8% lower than the sector weight. But notice with energy, it's the exact opposite. The earnings weight makes up 12.7% of the S&P 500, while the sector weight is only 4.6%. So you have a sector that is the cheapest in terms of valuation. It's got a 12.7% earnings weight in the S&P 500, but the stock prices, the actual sector weight is only 4.6%. In other words, that's an 8.1% spread. That is incredibly, incredibly attractive for us. And one of the reasons is one of our biggest overweights in some of our customized portfolios. And so when we look at the total inventory that's being held right now, it continues to drop. We've got a little bit of rise here, but that structural long-term picture continues to plummet for the inventory of crude oil. And so we just want to focus on investing in the discarded, right? So when we look at Bloomberg's search interest for oil and gas stocks, all-time lows. There's no interest in it, despite the fact these companies are growing like weeds. They got dividend yields, 6 to 8%, solid, rock solid balance sheets, and solid long-term free cash flow growth, but no interest. Why? Well, I got to own tech. I got to own AI. You own AI, sold to you at these prices. And maybe they go higher for another week. That's fine. Let's talk in a year, right? So the other area we want to look at, of course, energy relative to tech, right? Again, in that 99th percentile. When you get into these extreme percentiles, that mean reversion becomes your big risk, both to the upside and the downside. So what's the bottom line here, ladies and gentlemen? We believe that every day that this bubble in technology expands, the more dangerous it becomes. You can have 3 months of a rally, and those 3 months can be wiped out in a couple of days. So we're fine avoiding picking up pennies in front of a tractor. We're not going to do it. We remain focused elsewhere. So the three big things: we do think this technology bubble is dangerous, as you might have surmised by now. It represents a huge piece of investor portfolios, and that's what we're trying to avoid. Number two, we believe the labor market is beginning to crack, and this does bear watching. Very, very important. And lastly, if the technology bubble pops, we do expect dollars to flow into commodities, into other value sectors, perhaps industrials, utilities, et cetera. We're focused on the commodities area of the market. So that's our picture for this week. If you have any questions, 888-543-3776, please reach out to your advisor, and we'll be glad to answer any questions you have. But have a fantastic week, and we certainly look forward to hearing from you soon. Talk to you later. Bye.